tell you why.
Where's your stock? Where's your stock? You never gave me one of your stocks.
Okay, I'll give you one. But
Now.
you want to stop right now?
Yeah.
I'll tell you how I choose stocks.
Oh, okay.
Now, the problem I have with growth, okay?
George, I'm not going to talk about the problems I have with God.
You can.
You don't want me to start. You don't want me to start.
Ben Graham used to say that financial analysts are intelligent, honest, decent people, but they spend a lot of time in trying to do something they cannot do well. And this forecasting. I think growth, you have to forecast growth, okay? And it's very difficult to forecast growth. Growth is here today, gone tomorrow. And we know evidence shows that investors overpay for growth. As value investors, we don't like to pay for growth, even though sometimes we do incorporate growth in our models. We don't want to pay for growth. We want growth for free. A company to grow again in the long run, the company must have some competitive advantage, which can sustain and maintain in the long run. The company has to be able, in the long run, to have a return on capital that exceeds the cost of raising funds. Now, we don't believe that many companies can do this to infinity forever. It's like, okay, they can do this for the next couple of years, but the question is, as a value investor, as a long-term investor, if this company has great returns, why don't anybody come in? Are there competitive advantages in this industry? I'm not sure. So why don't competitors come in? Will they come in? If they come in, then we'll take away your high returns. And once your return moves down to the cost of capital, you don't add value anymore. So we do incorporate growth for some special cases of companies. But even if we calculate intrinsic value with growth, let's say $100, we're not going to pay $100, okay? Because we don't trust growth. What we're going to pay, the maximum we're going to pay, is the value we're going to get without growth. And the difference between the value without growth and growth is our margin of safety. This is how we protect our capital. This is how we manage risk. By buying something that's worth for $1.50. And this 50-cent difference is our margin of safety. We don't know what's going to happen in the future. And for what I know, the business model may change. The management may have cooked the books. So we want to protect our capital. That's our main focus, to protect our capital. And that's why we take this margin of safety. Okay, so tell me why you don't like the farming.
Well, I'm not here to throw stones, George.
Let's try to never debate.
And two things occurred to me. I enjoyed your presentation yesterday, by the way. I want you to know that.
But
two things, so I stumbled over two things here. One was the fact that your database, the set of data that you're using in your analysis, it's like 650 companies or 800, okay? I don't know how many companies are on the TSX, but it's like 1,500 or 2,000. And, when you're winning that down to like a third of the universe, to make generalizations about Toronto stocks or growth stocks or the guys, I just have difficulty with that. But the other thing, the conceptual difficulty with that, is the way you divide the universe into low PE stocks and high PE stocks, okay? Because there's really a third kind of stock. There's growth stocks, there's value stocks, and there are cyclical stocks, okay? And cyclical stocks have to be controlled for because the PEs get all messed up. Okay? Because this, you said low stocks, value stocks have low PE multiples. Okay, that's what you say. And high PE multiples are growth stocks. Well, high PE multiples are also cyclical stocks at the bottom of their cycle. Think of it. Okay, you got a cyclical company like the steel company or the gold, one of the resources. Okay, the earnings go like this and they go down, they go back up. You know, as the prices of commodities drive those products. Okay, so what happens like a Noranda or an Inco? Big companies, not going out of business. Okay, so the price, the earnings go down. The price bars are following the earnings profile, and then the earnings start to go down. Okay, as the price will build to excess capacity. So the price, the earnings start to go down, and the price bars, okay, either follow them down or not quite follow them down because everybody knows they're not going out of business. Okay, that's going to come back. Okay, so what happens to the price earnings ratio when the company's earnings are really at the bottom of their trough? The price hasn't come down proportionally with them. The earnings are real small, okay, pennies or even negative. What happens to the price earnings ratio? It goes through the roof. Okay, they're very high. Now, when do you want to buy a cyclical stock? You want to buy when its multiple is high or when it's low? You want to buy at the top of the cycle or the bottom of the cycle? You want to buy at the bottom of the cycle, right? When the multiple is through the roof. And when do you want to sell a cyclical stock? Well, when those earnings come back up, the price is still there, maybe that goes up a little too, but the earnings come back violently off the cyclicals. Okay, what happens to the multiple at the top of the cycle? Price, big earnings, multiples very small. So I'm the last guy who wants to buy a cyclical stock at the top of the market. But that's when you have small multiples. So this whole division, if you don't control the data set for these wildly swinging multiples, then I think it's capable of skewing results immensely, particularly if you only got the third of the universe.
Well, but my data
That's what I
are
want.
not skewed, right? I look at them many different ways. But the thing is, you know, it's not just Canada. Okay, in the US, value with growth. Internationally, value with growth was 13 to 15%. And they do this at any business point of the business cycle.
But I'll tell you why, George. Okay? I'll tell you why, because none of them control for cyclical stocks. Those wild PEs, those wildly high PEs for cyclicals at the low point distort everything. You put those monster PEs with the PEs for growth stocks and the PEs for cyclical stocks, and the very small multiples at the top. So you're going to have a very questionable. I'm sorry, just my view. Very questionable data set. Very questionable. But anyway,
Any questions for the group?
I think you should highly control that. The opposite happens with book values.
And I looked by industry as well. So I look at the industry that you are not cyclical and still.
well, if you zero in on just on the cyclical industry, you're going to have it all screwed up. Because you want to buy
by
the
industry. I divide by industry. And in the non-cyclical industries, you still see the value tree, not just a specific industry.
We're
I
into
look
the
at
cyclical.
the price to book values as well.
Okay.
George, can I ask you a question? Doesn't your data and analysis just in a broader sense supported the old theory called the dog to the down? Sell it, just buying value stocks. You buy the 5 with the lowest PE on December 31st, you sell them a year later. I think data has shown that rather than taking the money, dividing it evenly, investing it uniformly across the 30 or some Dow stocks, if you concentrated it every year in the one with the lowest price earning ratio, the Dow, you'll outperform.
Yeah, I mean, see, the thing is, what we believe, I guess, is that the markets are efficient. Markets overreact. On the upside, and on the downside. Low PE means, as I said before, pessimism. And the markets tend to, many times, to be over pessimistic. and as a result, they are selling too much the stock, and of course, after a point, the stock falls off so much that money starts coming in and buying the stock and moving it up again. The same also with growth stocks. You know, they are over optimistic that boosting the stock above its intrinsic value, and then some people start to realize the stock is really overappreciated, and they start taking money and the stock goes down. But you know, it's not just buying the low P and avoiding high P. As I said before, value investors, they use a three-step process. One is look at the P's. We look at the P's and we try to narrow down our sample in the possibly undervalued stocks. Then we do in-depth analysis. Okay, we go through the fundamentals, go through the management, through valuation, and we do valuation which incorporates balance sheet and discounted cash flow. We don't normally incorporate growth unless we believe the company does have a competitive advantage, and unless we believe the company can prevent competition from coming in and maintaining the ROI, the return on capital exceeding the cost of capital. But like I said, even in these cases, we don't want to pay for growth because we don't trust growth. And the third one, of course, is to have a discipline and a strategy. It's not clear for me, I guess, when do you get in and when do you get out of growth. At least with value, if your stock is below your margin of safety, you get in. You get out when the stock reaches your intrinsic value. So you get the in and out. And if you have a discipline, I guess, on when to enter and when to exit, and have a long-term perspective, I think evidence shows that value is beating the move. And I mean, why this persists? Sorry.
Valuating, you used PE ratios, and I'm wondering, free cash flow is more that than PE, because PE can come from, let's say, for example, Pfizer sold their division for Johnson & Johnson. Lately they are using their research and other factors, so the earnings are good. But
yeah, I don't use the PE for valuation. I use the PE as a screening mechanism. Okay, so
free cash flow?
Yeah, the second step, when you do the valuation, you do, one of the methods is a variation of the free cash flow. Okay, so our first step is we screen stocks. And I just mentioned PE, I guess, because this is one of them. But what you want to buy, what you want to screen, I guess, are stocks which are obscure and stocks which are undesirable. What this means is, obscure stocks are small stocks, stocks that are followed by few analysts. Undesirable stocks are stocks with low growth, low PE, temporary, I guess, company problems, like perhaps a lawsuit or poor subsidiary performance. What this enables you to do is to start like for, I don't know how, 1,700 stocks in the TSX and bring them down to 40 or 50. Once we have 40 or 50 stocks, which we think may be possibly undervalued because the investors have overreacted on the downside on these stocks, then we do in-depth valuation. And we follow two methods for the valuation. One is we look at the balance sheet, as is right now, and we look at replacement value of the balance sheet. That is, how much will the competitor be able to duplicate the company as it is right now? That gives us like a lower denominator. Then is how much cash flows can the company generate from these assets? The better the management, the better the cash flows that the company will be able to generate from the assets. Many times you have situations where the replacement value of the assets exceed the present value of the cash flows that we have. Now, this is an indication that the management is not working the assets properly. And most of the private equity, I guess, and most of what we see recently are companies. I mean, the private equity people, and the easiest way to make money is to find companies whose replacement value is above the present value of the cash flow, because it tells you the management is not working the assets properly. BCE, I guess, is a good example. And what happened is many value investors take positions in these kind of companies. They're trying to make changes many times in companies, like Third Avenue Fund, it had to do with Canfor and Catalyst. And you hope that with new management, with new strategies, the cash flow will exceed eventually the value of the replacement value of the assets. It's not so complicated, I guess, as appears when you have 20 spreadsheets with growth assumptions. The way I teach valuation from a value investing point of view is a lot of qualitative analysis, a lot of strategic analysis, and of course some number crunching. But you can do the number crunching actually in one page. You don't need really 10 different sheets. So I mean, the evidence shows that in Canada and the US globally, even the first step, especially the very mechanical step of running insurance by P, beat the high P. Now, value investors don't buy all these stocks. But from these stocks, they choose the ones they think are truly undervalued. Maybe they control for your cyclical example. And I think, personally, value investing works because of human psychology. People tend to extrapolate. People, investors, I guess, have psychological biases over which they have no control. So they extrapolate, they herd, and at the same time, you've got the professional portfolio managers who have their own conflicts, their own interests, which many times divert from the interest of the employer and the interest of the client. And you have portfolio managers who will balance the portfolio with the purpose of maximizing against the bonus, who window dress, who spruce up the portfolio when they prepare reports for the clients towards the end of the year. So towards the end of the year, you see many of the unloved stocks, many of the obscure stocks, many of the losing stocks are getting beaten up because many of these portfolio managers are getting rid of the stocks. And what I say, this time of the year is like stocks on sale. And also portfolio managers hurt, and they hurt because they want to protect their jobs. I mean, if everybody's here, you are there, you are on, you're toast. So because investors tend to extrapolate, to overreact, because they hurt, they tend to all get out at the same time or get in at the same time, and this overpriced or underpriced stocks below or above intrinsic value. And I think this is what gives rise to the value premium and the outperformance of value versus growth stocks. And many people tell me, oh, well, now that you're teaching value investing and you graduate 200 students every year, now value investing should disappear. And I say, not true, because, I mean, you know what makes a good value investor? What differentiates a great value investor from a normal value investor? It's not how well you screen stocks, it's not how well you value stocks. It's your personality, your temperament. And no matter how much I teach people the first and second step, if you don't have the temperament, you're not going to be a great investor, value investor. I mean, when your clients come in and say, what are you doing? All these young guys, they're making like 20, 30%, and you are like sitting like in 40% in cash, 50% in cash. And you can say, well, take it or leave it, this is what I'm doing. I mean, people were saying that Buffett was history in the late 90s. But Buffett stood his ground, and that's why he's a value investor. Yes. So I did a paper that I looked at from 1957 to 2003. And I looked at the average return between November to April and May to October. If for the last 50 years, if you had bought the index, especially if you have bought a smaller caps group of stocks in December, in November, and sold it in end of April, and for the rest of the year, you put your money in cash, treasury bills, money market funds, you would have made 24% return for the last 50 years. It seems to me from the data, we tend to talk generally that the stock market in the long run will give you, or historically at least, it's giving you about 11, 12%, the stock market. Well, all of this 11, 12% return happens between November and April. The average return between October and between April, May and October for the last 50 years was 0. I'm not saying this happens every year. I'm talking about an average. The question is, can you stay the course? This May has been good. Does this mean that this violates the 50 years of previous history? Well, from time to time, you're not going to have this happen. It's an average effect. It doesn't happen every year. It does not happen every year, but on average it happens. I think, if I remember well, 9 out of 10 times for the last 50 years, the October to April was positive. And I think the time that was not positive was during a recession year. Okay, so I think probably the best strategy would be to buy I guess systematically in October the low P's, and if you want to follow I guess a very active strategy, buy the low P's and see if they're still low P's by April I guess, and then revise your portfolio. I'm going to do this actually. I'm going to try to combine the value groupings with the seasonality driven by, and I mean, the seasonality, again, my theory, I guess, and we can talk about this later because we're having enough time, but my theory is that the seasonal behavior of stocks is driven by professional portfolio managers. Very balanced throughout the year, okay, very balanced. They tend to go at risk at the beginning of the year because they've got one year ahead of them to correct, I guess, if something goes wrong. But they want to maximize the return to get the bonus, right? So the beginning of the year, they buy high-risk stocks to beat their index, to beat the benchmarks. Throughout the year, so that's why at the beginning of the year, usually you see the smaller stocks, the more risky stocks, to do better. Throughout the year, as they realize, I guess, high returns to get the bonus, slowly they get out of the stock market. And this happens year in, year out, because the remuneration is based on a calendar year. So that's my theory, that the seasonal behavior of the stock market is driven by the conflicts of interest portfolio managers have when they manage someone's money. Okay, so I'll stop here, and I think we're having lunch. right now, or starting, I guess, to prepare for lunch. And then at 12 o'clock, Mr. Ken Watson will talk to us about Ben Graham and bottles. Okay? Thanks again.